When people hear the phrase generational wealth, the mind usually jumps to trust funds, giant stock portfolios, or sprawling estates. But in reality, lasting wealth usually starts smaller. It begins by owning something that consistently earns money, even when you aren't clocked in every morning. You do not need a six-figure income to start moving in this direction, and you certainly do not need to be born rich. The shift happens when you stop focusing on how to earn a bigger paycheck and start learning which specific asset categories can actually build lasting wealth. My name is Alex. I grew up in a household where every single dollar we had came directly from a paycheck. My parents worked hard and budgeted carefully, but that approach has a strict ceiling. A household income tied entirely to wages is permanently bottlenecked by the number of hours you can physically work. Nobody in my family owned anything that generated cash without our time directly attached to it. Once I understood the difference between earning money and owning something that earns for me, I stopped looking for overtime hours and started looking for ways to buy back my time. Before we get into the mechanics, take a second and make a mental list. Think about which of the 5 wealth-building categories you might already touch. If you have a standard retirement account through your employer, that counts. If your list is completely empty, pick just one category that feels realistic to start learning about over the next 12 months. That simple exercise helps pull wealth building out of the realm of vague daydreaming and turns it into a clear, measurable target. Earning a paycheck pays the bills and builds a decent life, but a paycheck stops the exact second you stop working. There is also a generational limitation to that model. You cannot pass your corporate position down to your children. Assets operate under a different set of rules. An asset is an economic entity that grows in value or produces income without requiring a one-to-one trade of your hours for dollars. This chart shows the difference. Wage earnings stop when work does, but assets, like rental properties or compounding investment accounts, generate value independently. A family business generates revenue beyond personal labor, and intellectual property, like a book or software, keeps paying royalties long after the initial work. That dual action separates families who build lasting wealth from families who keep starting over from scratch. One group earns money. The other group earns money while accumulating things that also earn. The families who successfully execute this strategy consistently rely on specific categories. The first two are business ownership and broad market investments. The next two take the form of physical and creative properties, real estate, and income-producing intellectual property. This chart illustrates the 5th category, a protective tax shelter for the other investments, making them more powerful over time. You don't need all 5 immediately. The most effective approach is to secure just 1 or 2 to begin with and build outward. Organizing these 5 categories provides a framework for growth. It moves the conversation away from the ambiguity of saving money and toward the concrete acquisition of productive equity. Standard consumer habits usually involve earning, spending, and occasionally stashing leftover cash in a checking account. These 5 asset classes behave differently. Over long periods, they utilize compounding interest, a process where the returns on your initial investments begin generating their own additional returns. Once you understand how these specific pillars compound, you can see why relying solely on a traditional savings account cannot keep pace. People often try saving harder or working longer, but these standard financial moves rarely lead to lasting wealth. The money simply sits in an account, waiting to be spent. A generational asset meets 3 criteria. It grows without more working hours, produces autonomous income, and is transferable. It's like a planted tree yielding fruit yearly, independent of daily effort. But with a paycheck, when the input of labor stops, pay instantly stops too. Earning a higher wage is a distinct action from acquiring things that generate money. This is the structural shift most people miss. To build wealth that outlasts your finite working years, you have to transition from being an earner to being an owner. In the modern economy, this transition is typically executed across 5 practical wealth-building categories. The first category is business ownership. A well-engineered business creates income beyond a personal paycheck. As the system matures and hires out roles, it progressively relies less on the owner's daily physical labor to operate. The second category is broad market investing. Broad markets utilize fractional ownership, allowing you to own tiny pieces of hundreds of companies at the exact same time. This line graph demonstrates overall growth trends persisting over decades, despite unavoidable intermittent market downturns along the way. Both categories allow you to harness the productive output of entire organizations, rather than relying solely on the limited hours in your own day. The next categories involve physical properties and specialized digital structures. Real estate offers dual wealth benefits. It generates steady cash flow, frequently rises in value over time, and is highly transferable to family. The fourth category involves specialized structures known as tax-advantaged containers, like a Roth IRA or 401k. A Roth IRA is an individual retirement account that offers tax-free growth and tax-free withdrawals for long-term investors. The account is not the asset itself, it is a protective shell. The container acts as a structural boundary, shielding your internal investments from external tax extraction. Utilizing these specific accounts improves your long-term tax efficiency, preserving more of your capital depending on your timeline and individual situation. The fifth category is income-producing intellectual property. Scalable digital work, like a software program, a book, or a template, continues to earn revenue long after the initial creation phase is finished. Understanding the mechanics of these different asset types allows you to match your wealth-building strategy to your specific current resources and skill sets. Executing this strategy does not require vast amounts of initial capital. A major psychological barrier is the assumption that you need to be rich to start. In reality, beginning requires an investment of time, skill, or very small amounts of money. Set up small, automated investments, start a simple home business, or outline a digital product with almost zero upfront costs. In asset layering, income generated by one asset, like a business, funds another, like investments. Those investments build a real estate fund, which feeds retirement accounts. The system accelerates, reinforcing itself as the structural loops interlock. But early strategic mistakes in this layering process can instantly halt your momentum before the system ever becomes self-sustaining. True generational wealth is the deliberate engineering of an interconnected asset system that eventually runs entirely on its own power. You know the 5 asset categories. You understand why they matter. Now, we need to look at what actually moves the needle in the real world. Real progress happens when you identify and stop the specific behaviors that actively sabotage your growth. Dodging the behavioral traps that wipe out average investors is critical to building a portfolio that lasts. Mistake number 1 is starting with the most expensive asset first. People hear generational wealth, immediately drain their savings to force a house down payment. You lock into a mortgage you can barely afford, and one unexpected expense knocks you into a severe deficit. Broad market investing, or a small business, is a realistic step to establish a stable financial margin first. Acquiring an expensive asset before you have that stable cash flow creates intense pressure instead of actual wealth. Mistake number 2 is treating standard assets like businesses, stocks, or property as get-rich-quick opportunities. This is the person who tries to launch a viral product on day 1, or day trades, or attempts to flip a house after watching a few online videos. If a strategy relies entirely on perfect market timing or catching one incredibly lucky break, you are running a gamble, not a system. A comparative line graph shows the difference. A timing-based gamble produces volatile spikes and crashes, whereas real generational wealth is built through boring consistency, smoothly compounding over multiple years. Real wealth is built through structural consistency, but trying to rush the timeline usually destroys the actual progress. Mistake number 3 is waiting until you feel rich enough to begin. People tell themselves they will start investing after their next raise, or launch a business when life is less busy. Waiting for the perfect moment continuously pushes your start date back, permanently costing you your most valuable asset, time. Many solid wealth-building plans start small and look boring at first. That is normal, and while you wait, you lose time, which is one of the biggest advantages long-term assets have. Mistake number 4 is buying assets you do not truly understand. This happens when people buy into unfamiliar property markets or copy business models they have absolutely no idea how to run. This tripart logic tree breaks down the required understanding for any asset. You do not need total expertise to start, but you must define these 3 measurable branches: the asset's purpose, its holding costs, and a clear baseline risk assessment. There is a simple rule for this. If you cannot explain the basic logic of an investment in plain English, you must stop. Clear comprehension is your primary defense against catastrophic loss. Complexity is a red flag, not a badge of honor. Mistake number 5. Copying what wealthy people do now instead of what they did when they started. Those individuals did not start with scale. They began with a single, highly manageable small investment or a very simple side project. Attempting to copy the finished version of someone else's decades-long wealth journey leads directly to burnout and terrible financial decisions. Scale has to be earned through direct experience. Trying to start at the finish line inevitably collapses your progress. The pattern behind all 5 of these mistakes is identical. People are desperately attempting to skip the foundational phase of wealth building. This timeline graphic illustrates the reality. Generational wealth is rarely one dramatic, high-stakes move. It is a series of steady, manageable ownership decisions made consistently over a lifetime to form a stable structure. Now that we know what to avoid, we can focus on the exact scalable steps you can begin implementing today. Mastering these unglamorous fundamentals of steady ownership today is the only guaranteed path to building wealth that survives the test of time. You already understand the 5 main categories of wealth. You know exactly which financial habits to stop doing. Now it is time to focus entirely on execution. Here is exactly what you need to do next. Before we get to step 1, we need to establish an operating rule. You do not need to tackle all 7 of these steps at once. The goal here is to get your first 1 or 2 steps moving today, and then gradually add the rest into your routine over time. That is how this process actually works in the real world. By starting small and isolating your actions, you avoid decision paralysis. Building generational wealth goes from feeling like an overwhelming life overhaul to a highly achievable sequence of individual steps. Step 1. Log into every financial account you currently have and check whether you have named a specific beneficiary or a transfer on death designation. A transfer on death designation is a legal tool that allows your assets to pass directly to a named person without going through probate court. Look at this flow diagram mapping out asset distribution. On the left, an account without a designated beneficiary gets trapped in a legal process that can delay the transfer for months and add intense stress to your family. On the right, an account with those details clearly filled out transfers directly and instantly to your designated individual. You want to run this audit starting with your retirement and investment portfolios. Once those are secure, check your standard bank accounts to see if your institution allows for designated transfers. Step 2 targets your employer-sponsored retirement plan. If your job offers a 401k match and your budget allows for it, check if you are contributing enough to max out that benefit. A 401k match is a program where your employer contributes a specific amount of money to your retirement account based on your own contributions. This animated bar chart demonstrates exactly why this matters. A baseline employee contribution sits at the bottom, and the employer match perfectly mirrors it on top, visibly doubling the total volume of the investment. You are effectively capturing guaranteed additional capital for long-term investments. By locking down your account beneficiaries and maximizing your free employer capital, you create a robust baseline defense. You accomplish this before ever risking a single dollar of your new personal funds. Step 3. If you meet the income requirements, look into opening a Roth IRA. A Roth IRA is an individual retirement account that allows your investments to grow tax-free, meaning you owe no taxes when you withdraw the funds in retirement. If that does not fit your situation, a standard brokerage account works just as well to start. Instead of trying to pick perfect individual stocks, direct your investments into a low-cost, broad market index fund. An index fund is a type of mutual fund or exchange-traded fund designed to follow preset rules, so it tracks a specified basket of underlying investments, capturing the growth of the overall market. This diagram illustrates a closed-loop financial system. It shows an automatic, recurring monthly transfer flowing from a primary holding account directly into an appreciating investment node. The mechanism here is setting a fixed monthly contribution and relying entirely on the habit, rather than trying to time the market. Because contribution limits, eligibility rules, and tax treatments fluctuate over time, take a moment to manually verify the current regulations when you set up your account. Step 4 moves away from the stock market and into your own mind. Take an inventory of your personal skills, specific processes you have optimized in your career, or hobbies you have spent years mastering. Once you identify something you know well enough to teach, draft a simple structural outline. It does not need to be finished today. You are simply organizing your specialized knowledge so it can be packaged. This outline is the seed of your intellectual property. In this context, intellectual property means transforming your raw knowledge into scalable guides, templates, or software that can be sold to generate future revenue. When you combine the hands-off financial automation of your index funds with the scalable, active creation of intellectual assets, you build a dual-engine system. You have capital growing quietly in the background and structured knowledge generating cash in the foreground. Step 5 is to identify a small, low-overhead business idea. This could be a simple online product or a service based on your professional skills that solves a highly visible problem around you. This does not need to be your dream company. The primary objective is to generate a secondary revenue stream that is completely independent of your standard salary, even if the initial returns are extremely modest. Step 6 targets physical property. Open a dedicated, highly segregated savings account and specifically label it as your future real estate fund. Set up a small, automatic monthly transfer into this property fund. Even if you are years away from buying real estate, you are simultaneously accumulating financial capital and building the behavioral readiness required to act when the right opportunity appears. Step 7. Initiate an honest discussion with your family regarding your long-term money goals and the exact physical and digital locations of your financial accounts. Verbally communicate the specific elements of your estate plan. Confirm who your beneficiaries are and disclose whether you have a basic will in place. A basic will is a legal document that outlines your exact wishes regarding the distribution of your property and the care of any minor children after your death. Spending your life acquiring assets accomplishes very little if the next generation lacks a clear, explicitly communicated roadmap to actually locate and manage them. Building generational wealth rarely hinges on a single brilliant financial maneuver. It relies entirely on the triad of owning the right assets, protecting them properly, and giving them the necessary time to compound. Notice the actual mechanics of the process. The vast majority of the steps we just outlined require absolutely no upfront financial cost to initiate. The barrier to entry is not a lack of capital. The most difficult shift in this entire architecture is making the psychological decision to simply sit down and begin. If you found clarity in this roadmap, tap the like button, send this to someone who works hard but hasn't started acquiring assets, and comment below with the very first asset you plan to build. Take your first step, automate your contributions, and maintain the habit. Consistency over time is the ultimate metric for success. I post new videos every Tuesday, Thursday, and Sunday. Subscribe, and I will see you in the next one.